The silver market just experienced something that has not happened in over 4 decades, and what I'm about to show you is not speculation, it is documented fact. In the span of a single trading session on January 30th, silver futures collapsed by 31.4%, marking the largest single-day drop since 1980 when the Hunt brothers tried to corner the entire market and failed spectacularly. Gold was not spared either, plunging over 9% in one day, its worst performance since 1983. But here is what should alarm you more than the price action itself. While paper silver on the COMEX was trading around $78 per ounce at the crash low, physical silver in Shanghai was simultaneously changing hands at over $115 per ounce. That is a 47% premium for the actual metal over the paper contract. This is Chart Chamber, and if you are serious about understanding what is really happening in financial markets, hit that subscribe button right now, because what I am about to walk you through is a systemic breakdown that most mainstream analysts are either missing or deliberately ignoring. And if this analysis helps you see through the noise, smash that like button to help this reach more people who need to understand what is unfolding. Now, let me be crystal clear about something before we dive deeper into the mechanics of what happened. This crash did not occur in a vacuum, and it certainly was not driven by fundamentals deteriorating overnight. In fact, the fundamental picture for silver has never been stronger. The Silver Institute reported that 2025 marked the 5th consecutive year of structural supply deficits in the silver market, with total shortfall estimated at 295 million ounces when you include investment demand through ETFs and physical purchases. Industrial consumption is accelerating because of 3 unstoppable megatrends. First, the solar energy build-out requires approximately 20 grams of silver per panel for conductivity, and global installations are expanding at record pace. Second, the artificial intelligence infrastructure boom is consuming massive amounts of silver for server components and high-performance computing systems. Third, electric vehicle production uses significantly more silver than traditional combustion engines, and that transition is not slowing down despite what some headlines might suggest. So how does a market with the strongest fundamental demand profile in decades suddenly experience a crash that wipes out 31% of value in a single session? The answer is not demand destruction. It is price manipulation through exchange mechanisms, and I can prove it. The CME Group, which operates the COMEX exchange where silver futures trade, raised margin requirements 5 separate times between late December 2025 and early February 2026. Let me explain what that means for anyone not familiar with futures trading mechanics. When you trade a futures contract, you do not pay the full value up front. You post what is called margin, which is essentially a good faith deposit. For silver, that margin requirement was historically around 11% of the contract value. On January 31st, the CME raised silver margins from 11% to 15% for standard traders, and from 12.1% to 16.5% for accounts classified as heightened risk. That is a 36% increase in the capital required to hold the same position overnight. If you were controlling $100,000 worth of silver with $11,000 in margin, you suddenly needed $15,000, and if you did not have that extra $4,000 immediately available, your position got liquidated automatically at whatever price the market was trading at that moment. Now here is where it gets mathematically brutal. These margin hikes did not happen in isolation. They happened while the market was already under severe stress. The first hike came on December 29th, just as silver was pushing toward $80 per ounce. Another hike hit on January 2nd, then January 6th, then January 13th, and finally January 31st, right after the crash had already begun. Each margin increase forced traders to either deposit more cash or close positions. Forced selling creates downward price pressure. Lower prices trigger margin calls on other traders who were not affected by the initial liquidations. More forced selling, more price decline, a cascading liquidation event by design. Bloomberg reported that leveraged silver positions were being wiped out systematically, with some traders losing more than 60% of their account value in a single session when the ProShares Ultra Silver ETF, which provides 2 times leverage, dropped 62% on January 30th. But the margin hikes are only part of the story, and this is where the situation transitions from concerning to potentially criminal if you believe markets should reflect true supply and demand. On the exact same day that the CME raised margins in Chicago, the Shanghai Futures Exchange also raised margins by 20%, increasing requirements from 20% to 26% of contract value. Think about what that coordination implies. The United States and China do not agree on trade policy, do not agree on technology transfer, do not agree on currency valuations, do not agree on almost anything in the geopolitical arena. But on January 31st, 2026, both exchanges moved simultaneously to tighten margin requirements on silver futures. That is not coincidence, that is coordination. And when 2 adversarial nations coordinate on financial market infrastructure, you need to ask what they are both afraid of. I believe what they are afraid of is a delivery crisis that would expose the fractional reserve nature of the paper silver market. Let me walk you through the numbers that make this clear. According to data from the COMEX warehouse reports, registered silver inventory, which is the metal actually available for delivery against futures contracts, has declined by over 70% since 2020. As of early February 2026, COMEX registered silver stood at approximately 290 million ounces. Meanwhile, open interest for the March 2026 silver futures contract represents delivery obligations of over 500 million ounces. Read those numbers again carefully. The exchange has promised delivery of 500 million ounces. The warehouse contains 290 million ounces available for delivery. If just 58% of March contract holders stand for delivery instead of rolling forward or settling in cash, the registered inventory is completely exhausted. What happens when the 59th percent shows up with a futures contract demanding their silver? This is the nightmare scenario that no exchange wants to face, because if they cannot deliver, the entire price discovery mechanism of the futures market loses credibility permanently. The physical market is already screaming that this crisis is real. According to analysis from Bullion Star and multiple trading desks in Asia, physical silver premiums in Shanghai reached 12 to 13% above LBMA spot prices in late January, which is exceptionally high by any historical standard. In certain retail markets in Japan, premiums on silver coins hit 60% above spot on secondary platforms like Mercari, reflecting intense demand and limited availability. In Dubai, dealers were reporting 15% premiums over spot for immediate delivery, and even at those elevated prices, many dealers were sold out or operating with severely restricted inventory. This is not normal market behavior. This is what happens when the paper price diverges so far from physical reality that buyers will pay any premium to secure actual metal. Now let me show you the smoking gun that proves beyond doubt that the crash was artificial rather than fundamental. Pull up two prices right now and compare them. COMEX silver futures closed January 30th at $78.12 per ounce after the 31.4% crash. On the exact same day, physical silver on the Shanghai Gold Exchange was trading at $115 per ounce. And in some over-the-counter physical markets, transactions were reportedly clearing above $120 per ounce. That is a $37 to $42 spread between paper and physical. If silver was truly worth $78, no rational economic actor would pay $115 for the exact same commodity. The fact that sophisticated buyers, including industrial manufacturers who need silver for production, are paying these massive premiums tells you everything you need to know about which price is real and which price is manipulated. The premium is not narrowing either, which is what should happen if this was temporary dislocation. On February 2nd, the spread was still $35 per ounce between COMEX and Shanghai. Physical is holding firm while paper collapses, which is the exact opposite of what you would see in a genuine demand-driven crash. In a real crash, driven by deteriorating fundamentals, both paper and physical would decline together because the underlying value of the asset has changed. That is not what is happening here. One price reflects forced liquidation through exchange mechanisms. The other price reflects actual supply and demand in the physical market. I'm going to tell you who benefits from this divergence, and then you can draw your own conclusions about whether this is organic market movement or something else entirely. JP Morgan Chase, Bank of America, and HSBC have historically held massive short positions in silver futures, positions so large that they have paid over $1.2 billion in fines and settlements for precious metals manipulation between 2016 and 2025. That is documented legal fact, not conspiracy theory. Every dollar that silver declines generates profit for those short positions. When silver crashed 31% in one day, those entities made billions in a single session. I am not alleging that they caused the crash. I'm simply pointing out the mathematical reality of who profits when prices move this violently to the downside. The timing around the crash also deserves scrutiny because several events converged in a very narrow window. On January 29th, Reuters published a story claiming that the U.S. government was ending support for strategic mineral stockpiling, citing anonymous sources. Algorithmic trading systems immediately triggered sell programs. 3 hours later, the Department of Energy issued an official statement calling the article false and stating that it relied on sources that were either misinformed or deliberately misleading. But the algorithms do not reverse for corrections. The damage was already done. Also on January 29th, news leaked that Kevin Warsh, known as an inflation hawk, would be nominated as the next Federal Reserve Chairman. Official announcement came January 30th, but insiders knew the night before. Warsh is perceived as negative for precious metals because of his hawkish stance on monetary policy. So you have fake news, leaked nominations, and margin hikes all occurring within a 48-hour window, and the result is the worst silver crash in over 4 decades. Let me now explain what happened to retail traders who tried to exit during this chaos because this is where the situation crosses from market volatility into something that looks like entrapment. In China, the UBS SDIC Silver Fund was completely halted for an entire trading session. No buying, no selling, no liquidity, nothing. Imagine watching your positions implode by 30% while staring at a screen that will not accept any orders, frantically refreshing the page, calling customer service and being put on hold, watching your account value evaporate minute by minute with absolutely no ability to stop it. That is what thousands of Chinese retail investors experienced. In the United States, traders reported widespread platform issues, orders being rejected with error messages, systems showing overload warnings, customer service phone lines with wait times exceeding 2 hours. One trader documented 18 hours of attempting to close a futures position, with every single order being rejected by the exchange, 18 consecutive hours watching losses accumulate with no ability to execute a trade. Some traders reported that even days after the crash, they still could not access their accounts to see balances or execute new trades. The system was not just stressed, it was breaking down in real time. Think about the sequence of events carefully. First, they raised margins, forcing liquidations. Second, they halted trading and restricted order execution during peak volatility. Third, they raised margins again after the crash. If you were designing a system specifically to transfer wealth from retail long positions to institutional short positions, this is exactly the architecture you would build. Crash the price through forced selling, lock the exits so no one can escape, then raise margins again to ensure anyone who survived the first wave gets liquidated in the second wave. Now contrast what happened to retail traders with what smart money was doing during the same period. Physical delivery requests on COMEX have been surging. According to Shift Gold analysis, eligible silver inventory has been draining from COMEX warehouses at an accelerated pace since September 2025, with registered inventory seeing major outflows. In the most recent data from late January, metal was leaving COMEX vaults at a rate not seen in years, with buyers using futures contracts not for hedging or speculation, but explicitly for physical delivery and immediate removal from the exchange system. Who takes physical delivery during a price crash? Industrial users who need the metal for production and cannot afford supply chain disruptions. Sovereign wealth funds and central banks who understand that physical metal cannot be printed or rehypothecated. Smart money that recognizes the paper price has disconnected from physical reality and is using the dislocation to accumulate at artificially suppressed prices. While retail was being liquidated and locked out of their accounts, institutions were backing up trucks to COMEX warehouses and taking metal out of the system. That tells you everything you need to know about what the sophisticated players believe is coming next. Let me give you the geopolitical context that makes this physical shortage even more severe. On January 1st, 2026, China implemented new export controls on refined silver, officially classifying it as a strategic material and requiring special export licenses. China refines approximately 65% of the world's silver supply. They just told the rest of the world that you need our permission to access that metal, and we are prioritizing domestic industrial consumption. There is no alternative source that can replace 65% of global refining capacity on short notice. This is a supply shock with no easy solution, and it is happening at the exact moment when industrial demand is accelerating from AI infrastructure, solar deployment, and electric vehicle production. The physical market is also seeing stress in ways that go beyond just price premiums. Silver lease rates, which represent the cost to borrow physical silver for a specified period, have spiked to 8 to 10% annualized. Normal lease rates are around 0.5%. Lease rates at 8% mean that borrowers are so desperate for physical metal that they will pay 8% per year just to get temporary access. You do not pay 8% to borrow something unless you absolutely cannot find it anywhere else and you need it immediately. Those elevated lease rates make arbitrage between physical markets and paper markets effectively impossible because the cost of borrowing metal to move it between exchanges exceeds any potential profit from the price spread. That is another sign that the physical shortage is real and intensifying. I need to address what happened to specific businesses and institutions because the fallout from this crash is not theoretical. It is destroying real companies and real livelihoods around the world. In India, specifically in the jewelry trading hub of Rajkot, at least 44 silver trading firms declared bankruptcy in the week following the crash, with combined losses exceeding $425 million. These are family businesses that have been operating in the silver trade for generations, completely wiped out in a matter of days because they were caught on the wrong side of a cascading liquidation event. In London, 2 hedge funds suspended redemptions, meaning they cannot give their investors money back because their silver positions are underwater and they cannot sell without triggering further losses. These funds are effectively frozen, and their investors are trapped. This is not just market volatility, this is wealth destruction on a massive scale, and it is radiating out through the global financial system in ways that have not been fully recognized yet. So what happens next, and where does this go from here? I am not going to give you price predictions because in a situation like this, where market structure itself is breaking down, price targets are meaningless. Support levels that should theoretically hold can break like glass when you have forced liquidations overwhelming all other order flow. What I can tell you is what to watch to determine whether this situation is stabilizing or getting worse. First, watch the Shanghai premium. As of early February, physical silver in Shanghai is still trading $35 to $40 above COMEX futures. If that premium widens further toward $50 or $60, it means physical markets are rejecting paper prices entirely and the system is fragmenting beyond repair. If the premium narrows because physical prices start dropping, then maybe the manipulation thesis is wrong and fundamentals are actually deteriorating. But if the premium narrows because paper prices rise to meet physical, that is when you know the game has changed and physical reality is reasserting itself over paper manipulation. Second, watch COMEX vault levels. Every Friday, the exchange publishes warehouse stock data. If another 30 to 50 million ounces walks out of registered inventory over the next few weeks, the vaults will be nearly empty before March 1st notice day, which is when contract holders must declare whether they want cash settlement or physical delivery. Persistent outflows, despite crashing prices, tells you that institutional buyers believe the physical shortage is real. Third, watch silver lease rates. If they stay elevated at 8 to 10% or climb even higher, it confirms that the physical market is under extreme stress. Lease rates only spike like this when metal is genuinely scarce and borrowers have no other options. The last two times lease rates hit these levels were 1980 and 2011, and both periods preceded major price moves in silver. Fourth, watch March open interest on COMEX silver futures. If traders are capitulating and closing positions, open interest will decline sharply. If traders are holding despite margin hikes and price crashes, open interest stays elevated, which means delivery pressure is still building. High open interest going into first notice day is exactly what the exchanges are trying to prevent through these margin hikes, because high delivery demand with low physical inventory is the scenario that breaks the market. Fifth, watch for more trading halts and platform freezes. If additional funds suspend redemptions, if more platforms restrict order execution, if more traders report being locked out of accounts, that tells you the system is under increasing stress. Functioning markets do not freeze, stressed markets do. These 5 data points, the Shanghai premium, vault levels, lease rates, open interest, and system stress, are your leading indicators for what happens next. The data will tell you what is coming before anyone else figures it out. And in a situation this volatile, having that information edge could be the difference between surviving and getting wiped out. Let me be very clear about something crucial that gets lost when people focus only on price charts. This crash did not destroy wealth, it transferred wealth. On January 30th, billions of dollars moved from retail long positions into institutional short positions. That is not speculation. That is the mathematical reality of how futures markets work when prices move violently. Someone sold at $78 per ounce, while physical was trading at $115. That someone was retail traders getting liquidated by margin calls. Someone bought at $78 or accumulated short positions that they covered profitably. That someone was the institutions with the capital and market access to survive the forced liquidation event. When this reverses, and I believe it will reverse because physical reality always wins in the end, that wealth transfer happens again, but in the opposite direction. The question is not whether physical will eventually converge with paper. The question is which side of that convergence you are on when it happens. The gap between $78 on COMEX and $115 in Shanghai will close eventually. The laws of economics guarantee it. Someone will profit enormously when that gap closes. Here is what I am personally watching daily to track how this situation evolves. The Shanghai premium is the truth teller. It is the gap between what paper contracts say silver is worth and what buyers are actually paying for deliverable metal. If this premium widens beyond $50, it means the paper market is losing all credibility. If it narrows because physical drops, the shortage thesis might be wrong. If it narrows because paper rises to meet physical, that is your signal that the manipulation is ending and price discovery is shifting back to physical markets. COMEX vault data comes out every Friday. Last report showed continued outflows from registered inventory. If next week shows another 20 to 30 million ounces leaving the system, and especially if it is leaving during a period of declining prices, that is institutional accumulation during the crash, which is one of the strongest bullish signals you can get. Lease rates are currently 8 to 10%. If they climb to 12 or 15%, it means the physical shortage is intensifying. If they drop back toward normal levels around 0.5%, it might indicate that the shortage fears were overblown. Right now, they remain elevated, which supports the thesis that physical is genuinely scarce. March open interest is the big one. As of early February, despite everything that has happened, March silver futures still have massive open interest representing hundreds of millions of ounces of potential delivery obligations. If that open interest stays elevated as we approach first notice day on February 27th, and especially if people start standing for delivery in large numbers, the exchange faces an impossible choice. Deliver metal that does not exist in sufficient quantities, or start settling contracts in cash, which would effectively admit that the futures market cannot fulfill its core function. Either outcome is catastrophic for the credibility of paper silver markets. System stress indicators include trading halts, platform outages, funds suspending redemptions, and order execution problems. If we see more of these events, it confirms that the infrastructure underpinning the paper markets is buckling under the weight of physical delivery demands. These are not normal market corrections. These are signs of structural breakdown. I want to make sure everyone understands the fundamental picture that makes this crash so absurd when you step back and look at the bigger context. Silver has been in a supply deficit for 5 consecutive years, with the 2025 deficit being the deepest on record when you include investment demand. Mine supply is essentially flat because it takes 7 to 10 years to bring a new silver mine into production, and no one was investing in new capacity when silver was trading at $15 to $20 per ounce back in 2019 and 2020. Industrial demand is exploding because silver is irreplaceable in solar panels, 5G infrastructure, electric vehicles, and artificial intelligence hardware. There is no substitute that matches silver's electrical and thermal conductivity at a comparable cost. China, which controls 65% of global refining capacity, has restricted exports and classified silver as a strategic material. That supply is now ring-fenced for domestic consumption. Above-ground inventories in Western vaults have been declining for years, as investment demand and industrial consumption exceeded mine supply and recycling. COMEX registered inventory is down over 70% since 2020. Shanghai vault levels hit their lowest point since 2016. And ETF holdings have seen significant outflows as investors moved from paper exposure to physical ownership. So you have declining supply, surging industrial demand, export restrictions from the dominant refiner, and collapsing exchange inventories. That is the fundamental backdrop. And in that environment, the price crashed 31% in a single day. That only makes sense if paper prices have completely disconnected from physical reality, and exchange mechanisms are being used to suppress prices before delivery demands expose the shortage. Look, I'm not telling anyone what to do with their money. That is your decision based on your own research and risk tolerance. But if you're watching silver trade at $78 on COMEX while physical trades at $115 in Shanghai, you need to understand that you are watching 2 different markets. One is paper contracts being manipulated through margin requirements and forced liquidations. The other is actual metal changing hands in the real economy, where industrial users and institutional buyers are paying massive premiums because they need the physical commodity. It is increasingly difficult to source. Those 2 prices cannot stay $40 apart indefinitely. At some point, arbitrage forces or physical delivery demands will cause them to converge. When that convergence happens, someone will have bought at the bottom. Someone will have held through the forced liquidations and margin hikes. Someone will have recognized that the crash was artificial and the fundamentals were not only intact, but getting stronger. That could be you, or it could be the institutional players who are currently taking physical delivery while retail gets liquidated. The difference is not luck. It is risk management and understanding what you are actually looking at when you see these price moves. If you are holding physical silver, understand that the ticker price on your screen may not reflect what your metal is actually worth in a market, where physical premiums are running 40 to 50% above spot. If you are trading futures or leveraged ETFs, understand that you are exposed to margin calls and forced liquidations, regardless of whether you are fundamentally right about the long-term direction. If you are considering entering a position, understand that volatility like this can wipe out leveraged traders, even if they are correct about the ultimate outcome. Position sizing is not optional in this environment. It is the difference between surviving to see the thesis play out and getting stopped out at the worst possible moment. Let me give you the historical context that shows this is not the first time we have seen this playbook. In 1980, the Hunt brothers accumulated massive long positions in silver, driving prices from around $6 per ounce to over $50. The COMEX responded by implementing Silver Rule 7, which drastically limited the size of positions and increased margin requirements. The Hunt brothers could not meet the margin calls, were forced to liquidate, and silver crashed back to $10. In 2011, silver rallied from $18 to nearly $50 in a matter of months. The CME raised margin requirements 5 times in 9 days, forcing massive deleveraging. Silver crashed from $48 back to $30 in a week. Now, in 2026, we are seeing the exact same playbook again. Raise margins multiple times in a compressed time frame, force liquidations, crash the price. The difference this time is the underlying physical shortage is far more severe than it was in 1980 or 2011. In 1980, there was no structural supply deficit. In 2011, China was still exporting silver freely. In 2026, we have 5 years of accumulative deficits, Chinese export restrictions, and collapsing exchange inventories. That changes the equation fundamentally. The margin hikes might crash paper prices temporarily, but they cannot create silver that does not exist. They cannot change the fact that industrial demand is consuming more metal than mines produce. They cannot force China to resume exports. The physical reality is immovable, and eventually, paper has to reconcile with physical. It always does. Every single time throughout history, when paper claims diverge far enough from physical reality, the paper system breaks and physical wins. The only question is how much damage happens before that reconciliation occurs. Here is what I need you to understand about market structure and why this matters beyond just silver prices. The COMEX is not just a silver exchange, it is the benchmark for global silver price discovery. When industrial buyers need to purchase silver for manufacturing, when jewelers need to source metal, when ETFs need to acquire physical for their funds, they all reference COMEX futures prices. If COMEX loses credibility because it cannot deliver against its contracts, or if the divergence between COMEX and physical markets becomes so extreme that people stop trusting the futures price, then the entire global pricing mechanism for silver breaks down. Where does price discovery move if not COMEX? Probably to Shanghai and other Asian physical markets where actual metal changes hands. That represents a fundamental shift in financial power from Western paper markets to Eastern physical markets. This is not just about silver, it is about whether Western financial exchanges can maintain their role as global benchmarks, when physical commodities are increasingly concentrated in Asia. If Shanghai becomes the price setter for silver because they have the physical metal and COMEX is trading paper claims that cannot be delivered, that same dynamic could spread to other commodities. Copper, nickel, platinum, rare earths. China is already the dominant player in physical markets for most strategic materials. If they start asserting pricing power through their control of physical supply while Western exchanges trade increasingly disconnected paper contracts, we are watching a historic shift in how commodity markets function. That is the bigger story underneath the silver crash. It is not just about one metal, it is about the structure of global commodity trading and where real price discovery happens. I want to address something that some people might be thinking right now. Is this just conspiracy theory, or is this real? Let me give you the facts that are beyond dispute. Fact 1. Between 2016 and 2025, JP Morgan, Bank of America, HSBC, and other major banks paid over $1.2 billion in fines and settlements for manipulating precious metals markets. That is in court documents, not blog posts. Fact 2. The CME raised silver margins 5 times in 5 weeks, which is objectively verifiable from exchange notices. Fact 3. Physical silver in Shanghai traded at $35 to $40 premiums over COMEX during the crash, which is documented in Shanghai Gold Exchange data. Fact 4. COMEX registered inventory has declined over 70% since 2020, which is published in weekly warehouse reports. Fact 5. Silver has been in structural supply deficit for 5 consecutive years, which is reported by the Silver Institute. Fact 6. China implemented export controls on silver effective January 1st, 2026, which is official government policy. These are not opinions or theories, these are documented facts. Now you can draw your own conclusions about what those facts mean. Maybe you believe the margin hikes were purely routine volatility management, and the timing was coincidental. Maybe you believe the Shanghai premium is just logistics and arbitrage friction. Maybe you believe the supply deficit will magically resolve itself. That is your prerogative. But if you look at the documented facts and conclude that nothing unusual is happening and this is just normal market functioning, I would encourage you to think very carefully about what normal looks like. Because in a normal functioning market, paper and physical prices do not diverge by 40%. In a normal market, trading platforms do not freeze and halt redemptions during volatility. In a normal market, margins do not get raised 5 times in 5 weeks. This is not normal. And pretending it is normal because it is uncomfortable to acknowledge what is really happening does not change the reality of the situation. Let me talk about what this means for average investors who are not trading futures or holding massive positions. If you own shares of silver mining companies, understand that their costs are based on physical production, and their revenue is theoretically based on the price they receive for the metal they mine. If physical silver is trading at premiums far above COMEX futures, mining companies that sell into physical markets rather than through futures contracts could be receiving significantly more revenue than their stock prices reflect. First Majestic Silver, Pan American Silver, Wheaton Precious Metals. These companies are reportedly exploring selling more production directly into high premium physical markets rather than through benchmark linked contracts. If they successfully make that shift, their cash flows could dramatically exceed what the market is currently pricing in. If you own silver ETFs like SLV or PSLV, understand the difference between them. SLV is an unallocated trust, meaning you do not have a claim to specific bars, you have a claim to the trust which holds silver. In a genuine shortage where physical premiums explode, there is a risk that the trust struggles to acquire metal to meet redemptions. PSLV is a closed-end fund with allocated storage, meaning the metal is physically segregated and you have a claim to specific bars. In a crisis, allocated physical is far more valuable than paper claims. If you are considering buying physical silver yourself, understand that premiums over spot have already spiked to 15 to 20% at most dealers, and many products are simply sold out or back-ordered. That tells you the retail physical market is already extremely tight. If you are buying, expect to pay premiums and expect potential delays on delivery. If you are not involved in silver at all, but you are generally invested in financial markets, understand that forced liquidations in silver and gold are not isolated events. When leveraged positions get liquidated in one market, it often forces selling in other markets to meet margin calls and raise cash. That is why equity markets also saw volatility on January 30th and 31st. Contagion from commodity market stress can spread to other asset classes, especially in a highly leveraged financial system. This is relevant even if you do not own an ounce of silver. Now, I want to address the question of what happens if the COMEX actually runs out of deliverable silver. This is the scenario that everyone is watching for, but nobody wants to say out loud. If delivery demands exceed available registered inventory, the exchange has three options. Option 1, source more metal from somewhere else to fulfill delivery obligations. But where? COMEX inventories are already at multi-year lows. Shanghai is not exporting because of Chinese restrictions. London is seeing its own inventory pressures. There is no massive stockpile sitting idle that can be mobilized quickly. Option 2, force cash settlement of contracts that are supposed to be physically deliverable. This would be an admission that the futures market cannot perform its core function. It would destroy confidence in COMEX as a price discovery mechanism, and it would likely trigger lawsuits from contract holders who bought futures specifically to take physical delivery and are now being told they get cash instead. Option 3, and this is what I think is most likely, continue raising margins aggressively to force long positions to close before they reach delivery period. This is what we are watching happen in real time. The margin hikes are not just about managing volatility. They are about ensuring that March open interest declines enough that delivery demands stay below available inventory. If the exchange can liquidate enough long positions before first notice day, they avoid the crisis of having to choose between option 1 and option 2. But here's the problem with option 3. The more aggressively they raise margins, the more obvious it becomes that they are managing the market to prevent a delivery crisis, rather than allowing natural price discovery. That undermines confidence just as much as failing to deliver, maybe even more, because it makes the manipulation visible to everyone watching. There is no good outcome here for the exchange. Either they deliver and run out of metal, they fail to deliver and lose credibility, or they manipulate margins so aggressively that everyone can see they are rigging the market. All three options are bad. That is what a corner looks like. And despite what some people think, the market is being cornered not by speculators but by physical reality. Let me also address the comparison that keeps getting made to 2011. Yes, silver crashed hard in 2011 after the CME raised margins 5 times in 9 days, but the context was completely different. In 2011, silver rallied from $18 to $48, primarily on speculative momentum and investment demand. When margins got raised and leveraged positions got flushed out, price collapsed because the rally was driven by leverage, not fundamentals. In 2026, silver rallied to $121 on a combination of investment demand and genuine physical shortage. 5 years of supply deficits, surging industrial consumption, Chinese export restrictions, collapsing inventories. The fundamentals are not speculative, they are structural. That is why physical is holding at $115, even while paper crashed to $78. In 2011, physical followed paper down because there was no underlying shortage. In 2026, physical is not following paper down because the shortage is real. That is the critical difference. And it is why this time really is different. Let me talk about risk management, because this is where most traders get destroyed regardless of whether they are ultimately right or wrong about direction. If you are trading silver with leverage, understand that your position can be liquidated at the worst possible price through no fault of your own. It does not matter if you are fundamentally right about the long-term thesis. If margin requirements spike and you do not have excess cash to meet the call, you get sold out. That is what happened to thousands of traders in late January. They were right about the fundamentals, right about the supply shortage, right about the manipulation, and they still got wiped out because they could not survive the margin calls. If you are holding physical silver, you do not have margin call risk, but you do have liquidity risk. If you need to sell during a period when dealers are offline or platforms are frozen, you might not be able to execute at any price. Physical is the safest way to hold exposure to the silver thesis, but it is also the least liquid. If you are holding mining stocks or ETFs, you have different risks. Mining stocks can get hit by broader equity market sell-offs even if silver fundamentals are positive. ETFs, especially leveraged ones, can see their tracking error explode during volatility, and in extreme situations, they can suspend redemptions if they cannot source underlying metal. Every exposure method has different risk characteristics. The key is understanding those risks and sizing positions appropriately so that you can survive unexpected volatility. Because in a market this manipulated and this stressed, you should expect the unexpected. Let me give you the signal that would make me completely change my thesis. If the Shanghai premium collapses, not just narrows, but actually collapses back to normal levels of 1 or 2%, while COMEX stays low, that would tell me that physical buyers no longer believe in the shortage thesis and are not willing to pay premiums anymore. That would be a major red flag that maybe the fundamentals have changed in a way I'm not seeing. But as long as physical silver continues trading at $30 to $40 premiums over paper in multiple regions simultaneously, that is proof that the shortage is real, and buyers who need the actual metal are willing to pay far more than what paper contracts suggest. The premium is the truth, and right now the premium is screaming that paper prices are disconnected from reality. So here is where we are. Paper silver crashed 31% in one day, the largest drop since 1980. Physical silver held firm, trading at $35 to $40 premiums over paper. COMEX raised margins 5 times in 5 weeks, forcing systematic liquidations. Shanghai also raised margins on the same day as the final CME hike, showing coordination between adversarial nations. Registered COMEX inventory is down over 70% since 2020, with continued outflows despite crashing prices. Silver lease rates are at 8 to 10%, 20 times normal, showing desperate physical demand. China implemented strategic material export controls effective January 1st, ring-fencing 65% of global refining capacity. 5-year structural supply deficit continues with industrial demand accelerating from solar, AI, and electric vehicles. Retail traders were locked out of platforms and unable to exit positions during the crash. Institutions took physical delivery during the crash, removing metal from the exchange system. Physical premiums remain elevated in Shanghai, Dubai, Tokyo, and other markets globally. This is not a normal correction. This is a coordinated attack on leveraged long positions designed to flush out delivery demands before the March contract forces the exchange to deliver metal it does not have. The attack is working, longs are being destroyed, but the fundamentals have not changed. The shortage is real, the deficit is real, physical is trading at massive premiums, and eventually paper will reconcile with physical because it always does. If you want to understand what happens next, watch the 5 indicators I outlined: Shanghai premium, COMEX vault levels, lease rates, March open interest, and system stress. Those data points will tell you whether this situation is stabilizing or accelerating toward a breaking point. Drop your thoughts in the comments about what you think happens next with silver. If you found this analysis valuable, hit that like button to help it reach more people. And if you want daily coverage of what is really happening in financial markets beyond the mainstream narrative, subscribe to Chart Chamber right now. I'm tracking the situation every single day until it resolves one way or another. See you in the next video.